So why DeFi? First, DeFi stands for Decentralized Finance, and it is trying to rival and compete with CeFi, better known as centralized finance or the traditional financial system. So, Bitcoin was the first successful cryptocurrency, and it was released to the public in 2009 on January 3rd by Satoshi Nakamoto. And within the Genesis block, there was a message embedded that stated, "The Chancellor is on the brink," because in 2008, we had the Great Recession. We had the subprime mortgage crisis, and the contagion spread all throughout our global banking system. And so many people were afraid and awakened to how fragile and corrupt our monetary and banking system truly was. So Satoshi wanted to create something that would be able to compete with that system and give people an alternative. But the problem with Bitcoin is that, number one, it doesn't go far enough. Currency is just one aspect of finance, and you need more than just currency in order to be able to truly create a decentralized monetary system. Now, the problem with Bitcoin is that you can't build anything on top of it, right? Bitcoin is designed to only be a store of value because of the scripting language that Bitcoin utilizes. And at the end of the day, Bitcoin is designed to be digital gold. This is not a knock on Bitcoin. It is not an attack on Bitcoin. It's just simply letting you know that there are technical limitations to what Bitcoin can actually do. And this is where Ethereum comes into play. Now, Ethereum was created by Vitalik. And at the time of creating Ethereum, Vitalik was working for the Bitcoin magazine and trying to build Ethereum on Bitcoin. But again, as I just stated, because Bitcoin doesn't utilize a Turing-complete language, basically Bitcoin cannot do loops. You cannot program and build applications on top of the actual protocol. This is where Solidity comes into play. Solidity is a Turing-complete programming language, and Ethereum is trying to be a world supercomputer where any application that you can envision and think of, you can actually build on top of the Ethereum blockchain. And this has the ability to create a financial ecosystem where code is law, and we do not have to depend on bureaucrats or executives, and we don't have to have a repeat of 2008 where people are blindly trusting that these individuals truly know what they're doing. At the core of the Ethereum blockchain is smart contracts, and these smart contracts will be executed by code in a peer-to-peer fashion. And this will allow you to create a true and open financial ecosystem. Follow me here. Currency is just one aspect of finance. You have to begin to think a little bit bigger. You still want the same properties that Bitcoin offers you in terms of being censorship resistant, immutable, and transparent. But what about lending and borrowing with those same values? Derivatives trading with those same values, decentralized exchanges, insurance markets, money markets, debt markets, capital markets, real estate on a blockchain, car loans on a blockchain, tokenizing assets and bringing them on a blockchain, and so much more. And again, having the same principles that Bitcoin offers you. So you can have it where it's permissionless, meaning that anyone can access the ecosystem. All they need is an internet connection. Having decentralization where you don't have to trust in a bureaucrat or an executive, or having to worry about too big to fail, or worrying about certain banks who basically caused the problem getting bailed out. A true idea of trustlessness, meaning that I don't have to trust. I can verify and let code be the law. Transparency. I can go and audit these smart contracts and truly know how much money is in this particular protocol, how many users are in the Ethereum ecosystem, and truly knowing, did this protocol have a bug before? Real open and transparent finance. Censorship resistant, not worrying about if I belong to the wrong political affiliation, or if I'm outspoken about my government that they can shut me down, or if I live in the wrong region of the world not being able to get access to banking. And then programmable. Many promote Bitcoin as being programmable, but it's truly not. You only can really program some really simple things on top of the Bitcoin blockchain. Ethereum is true programmable money. Very important that you understand that going forward. Now, when we start talking about DeFi, I want you to think of DeFi like Legos. And DeFi utilizes a multi-layered architecture similar to Legos, where Ethereum is the base layer protocol. And each layer thereafter has its own distinct purpose. And each layer is interoperable, meaning because they use the same interface, you can simply plug and play and swap out different Legos on top of one another. This is extremely powerful when you start wanting to create your own stack. Now, let's compare that to the traditional banking system, or CeFi, where you may have old technology and now you have new technology, and the new technology can't really speak to the old technology. And this is why you have a lot of overlap in traditional finance. And this is why it's slow. It's hard to innovate because there's no true interoperability amongst departments and among, just staff and the technology that they're utilizing. Now, when we start thinking about this multi-layered approach, you have the settlement layer. And this is important because the actual state of the Ethereum ecosystem is being managed by the base layer. So therefore, we know on this block, what was the state of the blockchain? What balances belong to which accounts? Extremely important to really have true integration within an ecosystem. Then right above that, on the second layer, we have the asset layer. Because all of the tokens and assets being built on top of Ethereum, they utilize the same ERC interface. You can now use these particular tokens as assets and collateral to do both lending and borrowing. And we're going to cover that as we go throughout this presentation. And then above that, on the third layer, you have smart contracts where your program exchanges, loans, derivatives, and asset management right on top of the blockchain. You can have the code built into the ecosystem. Whereas when you think about Bitcoin in comparison, you have a lot of innovation happening within Bitcoin, but it's not happening on chain. It's happening within side chains or channels or third parties. And then therefore, you have to now trust some third party to update the state of the blockchain once these transactions leave and go to that side chain. Whereas with Ethereum, you can actually queue everything right on chain and be able to query that and know that. Then right above that, you have the application layer. This is where dApps come into play, right? So you have a graphical user interface where the user would be able to go in and input their information. And then that web page would then talk to the backend, the protocol, to facilitate the exchanges, the loans, the derivatives, etc. And then we have the aggregation layer. And this is where users now can build out their own stack. So think about this right now, right? You have a bank account. You may have a Robinhood account where you want to trade, and then you may have a savings account. Well, those are all three different independent companies and corporations. So you would have to have an independent app for each one of those applications that you want to interact with. Well, imagine if you could just create a stack where literally you can go from getting paid, saving, and investing all within one stack. And then as you invest into Apple shares, you can then turn around and flip that and use it as collateral to get a loan, all within one stack. Very, very powerful. And don't worry if you don't understand this, because we're going to show you this as we go throughout this course. So now let's think about the DeFi building blocks. When you look at the internet, which I'm going to reference as the Web 2.0, the internet is basically just a suite of protocols that's talking to each other, that's layered on top of one another. And DeFi is utilizing similar architecture, but in a decentralized way, which is going to usher in Web 3.0. Now, when you look here on the left-hand side and you look at these protocols, TCP, UDP, Ethernet, etc., you didn't have an opportunity to invest into those base layer protocols. So what ended up happening was that tech companies such as Facebook, Apple, Amazon, Netflix, Google, Snapchat, etc., they were able to capture the wealth at the tail end and then centralize that. And one of the problems with Web 2.0 is centralization and being able to censor individuals. And we're watching this happen right now with Twitter kicking Trump off and deplatforming Trump. We're watching this happen with these companies controlling so much of our data and the flow of information and news because you have a central point of failure. So therefore, you have to trust that Zuckerberg and all of these different executives and owners of these companies and Bezos, that they're going to do the right thing. And just to highlight another problem, and again, this is not about your politics, it's just telling you that it's problematic when you can be shadow banned or you could be kicked off of a platform and not know why. Even if you go back to the Hong Kong protesters who were protesting just for basic human rights, they literally, Twitter censored the hashtag where it wouldn't show up. You had HSBC simply shut down their bank accounts. That's extremely problematic. This is where Web 3.0 comes into play, where now with Ethereum being the base layer protocol, you have an opportunity to invest in the base layer protocol. And because smart contracts need gas and gas fees are paid in Ether, it creates this network effect where every application is reliant upon the base layer. So therefore, investing in Ethereum is going to allow you to capture all of the wealth that that ecosystem creates. But now, as the user of the Web 3.0, you have control over your assets, over your data, and you know now and understand what the rules are and what you're playing by. So this is extremely powerful when you hear people talk about Web 3.0 versus Web 2.0, because we're witnessing right now that these tech companies, they have too much power and not enough transparency into how they are levying and using their power. And when we think about DeFi right now, and I keep highlighting Ethereum, there are other platforms such as Polkadot, Tezos, Cardano, Avalanche, to name a few, that are participating with smart contracts. They have smart contract platforms, but 95% of the projects right now that exist, they exist on top of Ethereum. And as of today, there's over $23 billion locked into smart contracts. We're not talking about the market cap here. We're talking about people that's interacting with these different lending and borrowing protocols and yield farming and liquidity pools and automated market making pools. Literally $23 billion. And when you think about this in terms of a global financial ecosystem where we're talking about hundreds of trillions of dollars, this is a baby right now. So this is the value proposition as to what you should be looking for in terms of investing in these various protocols that we will be covering throughout this course. So now when we think about CeFi versus DeFi, on the left, we have the traditional financial system, which you and I are engaged in right now. And one of the biggest problems with it is that it lacks transparency. You truly do not know what's sitting on these companies' balance sheets because they can maneuver in ways and set up deals and broker deals in ways where they can hide their risks or their exposure to particular assets. I.e., think about the 2008 market crash. And we're going to get to a video later on in this presentation where you had experts like Ben Bernanke telling you not to worry about it. But what we realized is that there's a domino effect with CeFi because there's a central point of failure and these banks are all linked together. If one fails, it starts this domino effect where the entire system starts to fail, because if this bank fails, then this insurance company that's insuring the derivatives, they begin to fail. And then if they fail, then certain automakers and credit unions, because they're getting their credit lines from commercial banks, if the central bank if the commercial bank fails, then these other entities begin to fail, and it creates this domino effect where then it bleeds into the Main Street economy. So it lacks transparency. And then because it's a central point of failure, the banks that are too big to fail, they get bailed out. And then what ends up happening? Because they get bailed out and they're too big to fail, they then go and buy up smaller banks and pay out bonuses. This is extremely problematic, and it's slow and it's expensive. Think about the SWIFT banking system. If you want to wire money to someone or send money to someone, you have to go all the way down to the bank, and then you have to fill out an application and then basically get treated like you're some type of criminal to access your own money. Now, we do have some online features as of today. But even those future features, they're not as robust. You can't send as much money as you truly want to. You're limited in what you can actually do, and it's expensive, the traditional financial system, because they're basically holding your money, and therefore they have to charge you a fee to hold that money. And most importantly, it's permissioned. So you only can be a member of that bank if they say so. And you need to have adequate ID. You need to live in a certain jurisdiction in order to have access to banking services. It's permissioned, and you can be censored. Again, going back to the Hong Kong protesters, they were protesting for basic human rights, and the government was able to come in there and tell HSBC to shut their bank accounts down. The same thing just happened to Trump, where HSBC came out and stated that they're no longer going to do business with him because of his political affiliations. So this becomes problematic, because I know what you're thinking. Well, you may not be a Trump supporter, but you don't care about these things until it happens to you. So the fact that they can censor him means that eventually, if they want to, they can censor you. Now let's compare that to the decentralized financial system that's open and transparent. So therefore, everyone can view what's actually happening in the ecosystem, and it gets rid of this idea of contagion or balance sheet risk that a lot of these banks have, because I can pull up Aave and see what's Aave engaged in, and now I can make a sound decision if I want to put my money into this particular protocol, or if this protocol is safe or not trusting an earnings report or some third-party audit, but being able to myself pull up the blockchain data and see what's going on. It's permissionless and it's censorship resistant. Very important. All I need is internet connection, and I have access to banking services such as borrowing and lending. It's interoperable. So therefore, all of the technology works with one another because they're utilizing the same ERC20 interface, or ERC77 or ERC721. And it's faster and it's much cheaper. Think about this right now. If I wanted to send $2 or $3 million to someone, if I wanted to do that through the traditional financial system, I would have to go to the bank. I would have to fill out certain paperwork. It would then take 3 to 5 days in order to do so. And then it would take another 2 or 3 days for it to fully clear in another person's bank account. Whereas when you start thinking about DeFi and crypto, all I need is this individual's address, and within a matter of 15 seconds, the money's in this individual's bank account. In this individual's wallet. That's extremely powerful when you start thinking about it, and you can't be censored. Whether or not you like my speech, whether or not you like my politics, whether or not you like the color of my skin, you cannot stop me from using these services as long as I have an internet connection. Extremely powerful stuff there. Now, I know what you're thinking. How can you have all of these different cryptocurrencies? And again, what you have to understand is that, number one, these are not just currencies, these are technologies, and they're all designed to do different things. But what many of you don't understand or know about the traditional financial system is that when you send money to someone, multiple people or institutions touch your money before it gets to the individual. And the fees are just basically, they're built into the cost of doing business. So this is why you pay a monthly maintenance fee to your bank if you don't have enough money in your bank account. Or this is why PayPal charges you 3% or 4% of the transaction. But what you don't realize is that when you want to send money, your bank charges you a fee. Again, it's just built into the cost of doing business, so you don't see it. But trust me, it's there. Then Visa or MasterCard, they're going to charge you a fee. Then if you go through Venmo or PayPal or some type of a merchant service, they charge you a fee. And then the recipient, their bank charges a fee, and then the money eventually gets to the receiver. So multiple people, about 4 to 5 people, touch your money and take a fee that you don't even realize because they're built into the price of the goods and services that you're buying. Whereas in a decentralized financial system, it's peer-to-peer. It's you interacting with a smart contract, and then once it's executed, the commerce is then sent to the receiver. Very, very important that you understand that. That is a peer-to-peer interaction as opposed to peer, bank, card, merchant, bank, peer. Very, very different, and therefore much more cost effective to the traditional financial ecosystem. Now, when we start thinking about CeFi versus DeFi, when you look at centralized finance, you have regulators colluding with executives to create regulation that makes it so expensive for the average person to truly be able to compete and create their own banks. And then when you look at right now what's happening with this revolving door, where you have bankers who work on Wall Street, and then eventually they go work in government. They pass a bunch of rules and regulations to benefit them and their banks and lock people like you and I out. And then they go back to the private sector. Think about this. Janet Yellen was the Federal Reserve chairwoman, and then she went from being the Fed chairwoman to going to lecturing Wall Street and getting paid fees and speaking. And now she's here and she's the Treasury Secretary. Look at someone like Hank Paulson, who worked at Goldman Sachs, and then he went to be the Secretary of Treasury, and then went back to working in the banking system. Look at someone like Timothy Geithner, same thing, working on Wall Street, then working for government, and then going back to Wall Street. So it becomes extremely problematic, and it creates this revolving door where, again, they're passing rules and regulations to benefit the banks at the expense of you and I, an American taxpayer. And then when you look at DeFi, DeFi allows anyone to compete in the financial economy with code and ideas. So it doesn't matter if you belong to the right association, if you went to the correct school, if you're plugged in with the right people. Literally, the most dangerous people in the world today are not people who hold guns or not politicians, but they're people who write lines of code. And this allows you to be able to truly get around all of that red tape and get around the gatekeepers and the barriers to entry, and really just be able to create technology in an open source way, which is extremely powerful. And it gets rid of the pay to play system. So therefore, we all know what we're engaged in, what the rules are, and we don't have to guess and worry about what's actually going on. Now, one of the most powerful things about DeFi is it brings transparency. So again, I don't have to trust what Ben Bernanke or Janet Yellen is telling me. I don't have to wait for an earnings report once every 4 quarters. I don't have to wait for the Fed to give me some economic indicator or data for me to make a decision. No, at my fingertips, I can literally query the blockchain and go and find out what's actually going on. Right now, we're looking at etherscan.io. I can see what is the price of Ether, what's the market cap, how many transactions are actually happening per second, what's the price of gas. I can see the hash rate, I can see the difficulty. I can go pull up the actual smart contract for particular protocols. So for example, let's think about Aave, which is a lending and borrowing protocol. I can go pull up the actual smart contract and I can see all of the transactions that's been happening within the past 15 seconds, the past hour, the past month, the past year, going all the way back to the Genesis block. So therefore, I can make decisions with accurate information rather than having to wait for a particular third party to tell me what the actual data may be. I can query the blockchain utilizing applications and tools such as Dune Analytics. So therefore, I can figure out how many people are actually using DeFi as of this second, as of this minute, not waiting again to the end of the quarter to wait for some type of a company to tell me, whether or not they grew users or not. And let's think about Wells Fargo that got caught where they was basically creating all of these fake accounts. Again, it's so easy to manipulate data and information when you're looking at the traditional banking system and financial infrastructure. You cannot do that with DeFi because it's open and it's transparent. And remember, the idea of something being immutable is that everyone has a copy of the actual blockchain and the state of the chain. So even if I try to cheat, there are thousands of other people that's running nodes that they have the accurate version of the truth. So even if I tried to cheat, the system will not allow me to be able to pass off my data that would be incorrect compared to the consensus rules. Very, very, very important. Data aggregation. So for example, I can right now make a comparison between what's happening with SushiSwap, which is a decentralized exchange, versus what's happening with Uniswap. And I can see how much volume was traded on SushiSwap or how much volume was traded within the past 24 hours, 7 days, or 30 days. This is important because now I can make sound financial decisions based upon information and not depending on some third-party analyst or individual telling me if whether or not there's a lot of activity happening within this particular blockchain or ecosystem. CeFi lacks transparency. as I just stated with Wells Fargo, how they were out here basically creating a bunch of false accounts. Again, they can manipulate data. You have to wait every quarter for earnings to come out. And you truly can't trust these earning reports because they can game the system. And by time the judicial system catches up to them, they get some petty fine where they actually earned more money to commit the crime than they actually ended up paying for the fine. So it doesn't make any sense. When we start thinking about the Federal Reserve Bank and how they can manipulate data, or we have to wait for them once a month or once a quarter to give us the update on what interest rates would be, or what's the unemployment rate, or for example, CPI, which stands for the Consumer Price Index. I want you to think about this. The Fed literally gets to pick and choose what goes in the inflation data. So we know that since 1913, when the Federal Reserve was created, that the dollar has lost 95% of its purchasing power. But they want to tell you that inflation is only running at 3%, but they don't include food and energy in those metrics, but they include a Netflix subscription. Well, guess what? You and I don't eat a Netflix subscription, right? So clearly they can manipulate the data as they see fit to benefit their worldview, to get you to make economic decisions that, again, you're making these decisions with information that's not accurate. You're depending and trusting a third party. Now, when we get to DeFi, code is law. So right here on the left-hand side, we have the 12 regional Federal Reserve banks. This is the map. And what you have to understand that these individuals are not elected by the American people. They are selected. And therefore, because of that, they get to collude with each other and create monetary policy, and they're not accountable to anyone. And therefore, the people who are the closest to the Federal Reserve and these individuals, it breeds corruption. And therefore, the government literally get to pick winners and losers. I really want you to think about that for a second. They really get to pick winners and losers at the expense of the American taxpayer. And the Federal Reserve, to this day, has not been officially audited top to bottom. They've had partial audits, but we haven't fully been able to audit them to truly know what are their relationships with commercial banks and with other central banks throughout the world. Because remember, they're supposed to be accountable to the U.S. government and a taxpayer, but the Federal Reserve in itself is a private entity with shareholders, and I've covered that in previous videos. Now, on the right-hand side, we have the smart contract for Mako, which is the reserve bank sitting on the Ethereum blockchain. And I don't have to guess what the rules are. This is a self-driving bank where code is law. I can go verify what the rules are and trust in code and not bureaucrats. And the rules are applicable to all, not just a few people. So again, we don't have to worry about government or central bankers picking winners or losers, and therefore allowing the banks that are too big to fail, that caused the problem, to get bigger and gobble up small banks and crush competition. And again, these smart contracts are auditable. Extremely, extremely important. Now, what we have to understand about these individuals, and I encourage you to read the book, The Price of Tomorrow, because Jeff Booth talks about this and speaks about this as well, is that these individuals that work at the Fed, they claim to be experts. These are supposed to be the world's brightest and smartest economists and minds, yet they consistently get it wrong. And the video that I'm about to play for you is Ben Bernanke leading up to the housing crash and the subprime crisis of 2008, where he was saying that the market is fine, that home prices will not have a significant drop, that the subprime crisis is contained to individual banks' balance sheets. And as we know today, that just absolutely isn't the truth. So this is the 5-minute video, but it's an important video to understand that you can't get it wrong for so long by a mistake. Either this is intentional or the system that we're participating in just is outdated and it doesn't work for the 21st century. So let's listen to Ben Bernanke.
Ben, there's been a lot of talk about a housing bubble, particularly, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates. We've got demographics supporting housing growth. We've got restricted supply in some places. So it's certainly understandable that the prices would go up some. I don't know whether prices are exactly where they should be, but I think it's fair to say that much of what's happened is supported by the strength of the economy.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth, not necessarily a national situation, but certainly froth in some areas?
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
This scenario envisions that consumer spending, supported by rising incomes and the recent decline in energy prices, will continue to grow near its trend rate, and that the drag on the economy from the housing sectors will gradually diminish. The motor vehicle sector may already be showing signs of strengthening. After having cut production significantly in recent months in response to the rise in the inventory of unsold vehicles, automakers appear to have boosted the assembly rate a bit in November, and they have scheduled further increases for December. The effects of the housing correction on real economic activity are likely to persist into next year, as I've already noted. But the rate of decline in home construction should slow as the inventory of unsold new homes is gradually worked down.
There's plenty of liquidity out there. He said he did not sense a lack of liquidity in the market. And he said we're monitoring the markets, but didn't really make any clues. So he went as far as he had to go, but not further.
He also calmed the fears about the subprime market, which were rippling through Wall Street yesterday, and said, we're taking a look at it, but right now it doesn't seem to be an issue, but we're watching it, certainly.
Yeah, that's exactly right. So let's first take a listen to what Ben Bernanke had to say about the economy.
So we expect moderate growth going forward. We believe that if the housing sector begins to stabilize, and if some of the inventory corrections that are still going on in manufacturing begin to be completed, that there's a reasonable possibility that we'll see some strengthening of the economy sometime during the middle of the year.
He went on to talk about the subprime market. Another fear yesterday was that there'd be contagion, but not in the eyes of Ben Bernanke.
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy, and the lending side of that still seems to be healthy. The pace of home sales seems likely to remain sluggish for a time, partly as a result of some tightening in lending standards and the recent increase in mortgage interest rates. Sales should ultimately be supported by growth in income and employment, as well as by mortgage rates that, despite the recent increase, remain fairly low relative to historical norms. However, even if demand stabilizes as we expect, the pace of construction will probably fall somewhat further as builders work down the stocks of unsold new homes. Thus, declines in residential construction will likely continue to weigh on economic growth over coming quarters, although the magnitude of the drag on growth should diminish over time. The global economy continues to be strong. Supported by solid economic growth abroad, U.S. exports should expand further in coming quarters. Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
So what I want to highlight here is literally this is supposed to be our best and brightest mind, and he completely got it wrong from 2005 all the way up to 2007, leading up to the Great Recession. Home prices continued to fall. Our exports shrank. We lost millions of dollars, millions of jobs. I mean, people's home equity values were completely wiped out. Like literally, he got everything completely wrong. The subprime crisis was not contained to banks' balance sheets. It was literally like a bomb that exploded, and the ripple effects were able to bring down the entire financial economy. And this is one of the biggest problems with CeFi. It's a fragile system, right? It's not anti-fragile. So what happens is that when things break, they create more rules and regulations that just makes the break happen. When the break happens again, worse than the first time. You want an anti-fragile system where, number one, when something breaks, it's contained to the particular aspect that broke. So for example, when we think about DeFi, if one of these DeFi protocols, if they have a problem, the risk is contained within that particular protocol. Now, yes, the crypto market may drop temporarily, but the actual risk in terms of the contagion is contained within that particular ecosystem and protocol. And because these are like building blocks and Legos, you can just swap out that particular protocol whenever there is a problem. All right. So now let's talk about the value of DeFi and why is this so important going forward? So here we have Ethereum as a base layer. And one of the most fundamental and powerful breakthroughs that happened was the creation of Maker. Maker is a DAO, which stands for a decentralized autonomous organization. And again, code is law within this organization. It's not like there's a bunch of bureaucrats or executives getting together and forming the rules to the game in privacy and secrecy. No, you actually get a chance to buy the Maker token, which gives you ownership and gives you voting rights within the Maker system. So therefore, you can vote on the stability fee, which is similar to the Fed's fund rate. You can also vote on how much DAI will be in circulation, what will be different rules within the ecosystem. You actually get to vote on these things, and it's in a true democratic fashion, like a democracy. And then you have on top of that, you have DAI, which is the stable coin. A stable coin is designed to mirror the US dollar. And DAI has a one-to-one peg with the US dollar, and it's an algorithmic stable coin. So now we have a self-driving bank sitting on top of Ethereum with Maker, which is the reserve bank similar to the Fed, where code is law. And then now we have a reserve currency sitting on top of Maker. So this now ushers in the idea of creating capital markets, because we have a central bank, we know what the true cost of money would be, and now we have a reserve currency. And then comes the next building block over here, which is compound, where now you can do lending and borrowing. So now we have true capital markets, and we have a true open and transparent financial system built on top of Ethereum. Now, the way that DAI operates is that Maker cannot just print DAI out of thin air like the Fed can do. The way that Maker operates is that there needs to be more collateral in the system than actual DAI in circulation. So for example, I'm going to get to this in a second. If I had $100 of Ethereum, I have to pledge that as collateral. And then I can borrow up to 75% of my collateral. So I can borrow $75 worth of DAI into circulation. But there's $100 worth of collateral. So there's a $25 buffer between the actual amount of collateral in the system and DAI in circulation. So this is a way that we can monitor how much currency is in circulation within the ecosystem. And the price of money is set based upon true supply and demand, which we will cover in the following videos. Now, when we think about stable coins, there are two types of stable coins right now. You have DAI, which is an algorithmic stable coin, and then you have Tether and USDC or USD coin. With DAI, Crypto collateral is actually the asset that's backing DAI. And it's programmed to mirror the US dollar, but it's truly decentralized, meaning that when you look at Tether, for example, for every Tether that's in circulation, there has to be $1 sitting in the Tether bank account, the company that owns Tether. This is a problem because now this is happening off-chain. And that dollar is sitting in a bank somewhere. We have to trust that the company behind Tether will not print more Tethers than the actual amount of dollars they have in reserve. Remember, with DAI, the only way DAI can come into circulation is you either have to buy it with crypto or you can do a loan and you can borrow up to 75% of the loan, right? So there has to be collateral in the system, but on chain, right? Not sitting in a bank account somewhere, because now if your funds are sitting in a bank account somewhere, there's counterparty risk because that bank can go out of business. As I just stated, Tether can create more Tethers in circulation than they actually have assets backing them. Governments can step in and seize the funds, right? And it's the possibility of censorship resistant because with USDC, which is USD coin, they actually have control over the ledger. So therefore, if your address is allegedly, or they deem it to be engaged in some type of criminal activity, they can literally just shut down your wallet because, again, it's a central company behind Tether and USDC versus with DAI, code is law. There is no one individual that controls the ledger. So currently there are two types of stablecoins. You have the decentralized ones like DAI, and then you have centralized stablecoins like Tether and USDC coin. Now, also understand that Tether and USDC, they are off-chain because remember, the collateral is being held somewhere. You're trusting a third party, a middleman, a custodian, whereas DAI is happening on-chain. Very important that you understand this. Now, the reason why you have stablecoins is sometimes you may want to hop out of crypto when the market is too volatile. Like, so for example, let's say that Ethereum is trading at $1,000 right now, and you believe something's going to happen and Ethereum may drop 30%, 40%. You can simply just hop out of your ETH at 1,000, hop into DAI, and then once the market corrects and finally stabilizes, you can go right back into ETH, right? So you may want to get out of volatile assets like crypto. Now let's talk about the circulation of DAI. Let's talk about borrowing, how borrowing works within the DeFi ecosystem. So you have Ether, which is short for Ethereum. I have $100 worth of Ethereum. What I can do is I can pledge that as collateral, and I can borrow up to 75% of that particular collateral. Now, different collateral has different borrowing terms. We're just using ETH for right now. You could borrow $75 worth of DAI into circulation. But understand that you would be right at the threshold to getting liquidated because the loan to value ratio, you'll literally be right at the cusp of that. Because think about it, ETH is trading up and down every second. So if the price of ETH drops down to $90 and you borrowed $75, that puts you in liquidation territory, right? Because the value dropped down. So therefore you're utilizing more 75% versus your collateral. So you have to keep that in mind. And we're going to cover that in more depth as we start using some of these protocols. Now, the way that it works is that once you pay back the loan, so if I borrowed $75, my ETH is sitting in a vault. It's known as a CDP, a collateralized debt position. Once I pay back the $75, I get back my ETH if I don't get liquidated, right? So I can simply borrow against my ETH, do whatever I need to do with the DAI, and then I can pay back that $75 loan and I get back my ETH. It's not like once you borrow against it, you can never get it back. As long as you pay back the loan, you can then get back your DAI. And yes, there are fees associated with borrowing against your crypto. That all depends on supply and demand, and we'll cover that in a later video because different protocols, they have different borrowing rates, and these rates are variable. Sometimes the rates can be as low as 3.5% to borrow, and they can spike as high as 20%. It all depends on which protocol that you're using. So keep that in mind. Now, in the event that you are liquidated, there is a 13% fee that you have to pay when you get liquidated, meaning that your collateral dropped below the threshold. Therefore, you would have to pay a 13% fee plus gas fees, and then your collateral will be returned back to you minus the fees. So it's not like they get to just keep all of your Ethereum. So let's just say, you had $100 worth of ETH, you borrowed up to $75, your collateral dropped down to, let's say, 90. Okay, you would get penalized, so you'll lose $13 and some change at that point, because that would be about 13% of your collateral, and then you'll get back the rest plus the fees. So figure you'll probably get back maybe $75, $72 of ETH, because your fees will be subtracted from your fees, plus the liquidation fee will be subtracted from your Ether. Now I know what you're thinking. Well, why would I want to borrow against my Ethereum? Well, it's really quite simple. You may want to have more exposure to crypto. So for example, think about this. I have $100 worth of Ethereum, and I can borrow, right, another $50 worth of Ethereum against my collateral, because you don't want to ever go right up to 75. That just doesn't make any sense. I would say it's better to be within the 40% or 50% range of the actual collateral. So follow me here. I pledge my $100 worth of Ethereum in a CDP, a collateralized debt position, and I borrow $50 worth of Ethereum. Now, let's say that the price of Ether goes from $100 to $200. Well, now my Ether that I pledged is worth more, and the Ether that I borrowed is now worth $150. So all I have to do is pay back the $50 from what I borrowed, and I can keep the rest. So this is the way that you can get more crypto and leverage the crypto that you have, because think about it. Most people, they just leave their crypto sitting in a wallet. So why not try to borrow against it so that you can get more crypto if you believe, for example, a Chainlink or an Ethereum is going to go up much more, like go up higher? It only makes sense, right? Also, another reason why you would want to borrow against your crypto is, remember that if you sell your crypto, that's a taxable event. So you may be in a situation where you need some cash right now, but you don't want to give up your Ethereum because you believe it's going to be higher, let's say a year from now or 2 years from now. So what you can do is you can borrow some DAI to go pay your living expenses, whatever the case may be. And then over time, if Ether becomes more valuable, right, you can also borrow more DAI as it goes up in price, or you just pay back the loan and get your Ether back. So it gives you flexibility to be able to get around taxes, but still be able to hold your crypto assets, because you may need cash right now, but you don't want to give up your Ether in the future. So just keep that in mind. And again, Ether is short for Ethereum. You can use both interchangeably. Now let's talk about lending, right? We just covered borrowing briefly. Now we're going to get into lending. Right now, traditional CDs are paying you, follow me here, around 1%, in some cases less than 1%. I've seen some CDs maybe around 1.5%. In crypto, the lending rates are what you actually are getting paid. You can, to lend out your crypto now, right? This is not you borrowing. You can actually lend out your crypto for other people to borrow, and they'll have to pay you interest. You can get paid anywhere from 18% right here. There's some protocols paying out 14.5%, different platforms. There's some platforms paying out, 6.8%, 6%, 14.22, 11, etc. Now, these are variable rates. They fluctuate up and down. But I just want you to see, think about that. You can earn 18% or 11.3% on your crypto. That's extremely powerful. And this is passive. This is me literally just taking my money, putting it in my MetaMask wallet, and lending it to a particular protocol. Very, very powerful. And this is with different stablecoins that you can do this. And these are the things that we will be covering throughout this course. Passive ways of earning money, and some more aggressive ways and active ways of earning money. So in closing, how does the DeFi ecosystem work? We have a permissionless store of value, which is ETH. That's the settlement layer. And because it utilizes Solidity, which is a Turing-complete programming language, we can build a permissionless reserve bank-like maker on top of it, and then be pegged to our own reserve currencies such as DAI. And then above that, we can have permissionless lending and borrowing, financial applications, permissionless bank accounts, and a permissionless world that will be able to compete with the centralized financial ecosystem.